Hello everyone, this is Chad Aiken coming to you from the Aiken Research Group. It is Wednesday, January 27th, 2016. Well, today we want to do this video on the number one reason we have a retirement crisis and the number one variable in the income inequality in America. That number one reason is the Social Security tax and contributions, along with it being the number one reason why we have a gap between the 1% and everyone else. Now today we did the 2 minutes in the danger zone, which we started to talk about the Social Security crisis, but only within 2 minutes, with how everyone is so busy today in America trying to save the money while Uncle Sam spends our Social Security contributions. Also, I will be sending out my article from aikenresearch.com entitled The Social Security Slot Machine. That article was written about a year and a half ago, and that article can probably be read in 10 minutes or so for those of you that don't have the time to actually get into the details of this YouTube video. So we're going to be able to expand upon the 2 minutes in the danger zone, talking about Social Security, along with my article in demonstrating why Social Security is the number one reason for the retirement crisis and the number one reason for income inequality. So let's get started. Well, everyone knows that we're required to pay Social Security contributions. They come out of your paycheck. How much comes out of your paycheck? Most Americans would be surprised to see how much they actually pay per paycheck or per month. Now, right now, if you make between $115,000 and $120,000 a year, you're going to pay 6.2% in Social Security tax, as well as your employer will match it. That 6.2%, by the way, comes out to be approximately $600 a month or $7,200 a year. Now, your employer would match that $7,200, so it would be a little over $14,000 a year that's being contributed, supposedly, for your retirement through Social Security. Now, what's ironic is that when Social Security was first initiated, it was because the government said that most Americans probably would not save that amount for their retirement. So that Uncle Sam needs to take that money from you, protect you from yourself from spending it, and then they basically would give it back to you 40 years later. Now, on the government statistics right now will say that every dollar of Social Security that you pay in, for a middle-aged person, you're going to get back 84 cents on the dollar. Now, that's not very good, right? Anytime we make an investment, we want to get more back. We want to get more than our dollar back on our investment. We're going to get 84 cents back. Now, those of you that are in your 20s and 30s, you're even going to get less back. I think that the number is anywhere in the high 60-some cents to maybe 70-some cents. It's even worse. But as bad as that is, of losing 16 cents on the dollar when you retire, what's even worse is the secret sauce as to why Social Security becomes such a destruction to the American household. And that is because those contributions are not invested. Those contributions, when invested year after year after year after year for 40 years, all of a sudden, the secret sauce to investing and creating wealth is the compounding nature of those returns. So what do we mean by that? Well, if you invest $100 and you get a 10% return, the next year you now are starting with $110. Now if you get another 10% return, you're getting 10% on the $10 gain that you had the first year. So your gains are compounding one on top of another. Now you can imagine after 40 years of contributing how much those gains would be. Well, the question is, for every dollar that you pay in Social Security, that you're getting back 84 cents, that dollar after 40 years should turn into $10. Now, can we guarantee that? No. But what we can guarantee is By you investing in Social Security, you're investing in a loser. You're getting back 84 cents on the dollar. This is why I entitled my article, The Social Security Slot Machine. The more you put into the slot machine, the less you get to take out. Now, let's run some numbers. So these glasses here are a typical taxpayer. This is the Social Security Trust Fund. And this big pot of dollars and green marbles is the total amount that Uncle Sam takes from the American taxpayer every single year. So let's take out 7 marbles, which would be the $7,000 that taxpayer number 1 is contributing. And taxpayer number 2, let's assume they're contributing their $7,000 a year. Now, if you make less than that, obviously you would pay about half. So if you make $60,000, you would be paying roughly $300 a month, or around $3,000. But let's take the extreme example. So what happens? So during the year, you pay your $7,000. Now, your employer also matches that. So a total of $14,000 goes into the Social Security Trust Fund. Now, some may even get more technical by saying it never even goes into the trust fund. It actually just goes into the Treasury, the unified budget of the Treasury. And then what they do is they credit an accounting entry that in the Social Security Trust Fund, there should be $14,000 from taxpayer number 1. Now, let's also talk about, through the last 20 or 30 years, the amount that everybody is contributing into the Social Security Trust Fund. There was an extra amount in there that when they paid out the benefits to Social Security recipients, there was extra. What did they do with the extra? Let's assume there's some extra. Let's assume there's some extra every year dollars in the Social Security Trust Fund. Did they save those dollars? No. What did they do with them? They dumped them in the general fund of the Treasury. We know that the Treasury every year has a deficit. So not only did they take from Social Security, but then they created a deficit on top of that. Now we have a $19 trillion debt over the last 20 to 30 years. Now, when they took the extra dollars out of the Social Security Trust Fund, what did they do? Well, they technically say that they invest in non-marketable securities. And what that's like is, it's like writing a check. Let's say that the extra amount was $10,000. They put a $10,000 check in there. Now, ironically, they call that check an asset when it's really a liability. Now, when we talk about the American taxpayer, the Federal Reserve, and the U.S. Treasury, it's like a who's on first, what's on second. I have no idea. I can't even follow this on third base. I mean, get out your Tylenol, because it's hard to follow. But what basically Uncle Sam does is they believe that this is an asset because it's owed to them by the taxpayer. But basically, they spent the money. Ironically, the reason Social Security came into effect is to save Americans from spending some of their retirement savings if they were able to keep it. Well, what ended up happening was Uncle Sam said, well, here, we'll take that money from you, and not only won't we save some of it, we're going to save none of it. We're going to spend it all. They even spent the extra. That extra amount accounts for between $2.5 to $3 trillion over the last 30 years. Now, according to some experts in Congress, they're not even concerned about owing $2 to $3 trillion that they spent out of the Social Security Trust Fund. Why? Well, because they know out into the future they owe so much more that makes that $2 to $3 trillion seem like peanuts. Let's just say you owe your friend $100 and you have $1 on you. Do you enjoy that $1 yourself, or do you give it to your friend because you owe him 100? You see what I mean? See, Congress spent the $2 to $3 trillion because they knew what difference does it make if we save it or not, because we're going to owe trillions of dollars in pension funds or Social Security to Americans. They spent it. Now, what happens next? Well, this IOU is actually purchasing securities, non-marketable bonds. Those bonds are owed an interest rate. Here's what happens. As long as the contributions are more coming in than what's going out, then all Congress has to do is, let's assume they owe $1,000 of interest. All they do is write another check for $1,000 and put it as an IOU in the Social Security Trust Fund. So now they owe $11,000. So they don't even really have to pay for the interest. And then the next year they owe more interest. And as long as there's more money coming in than going out, they can keep writing these checks that they never have to pay for. But what happened near 2010? The money coming in is not sufficient to pay all of the retirees. Now, I know we've heard that, well, I thought Social Security is solvent. I mean, does the average person think that if we're taking in less than we're paying out, is that a good sign? Does that mean it's solvent? Well, in government definitions, it's solvent, and let me explain why. While the amount that's going into the trust fund is not enough to cover the outflows to the retirees, in our case and in our example, we owe $1,000 in interest to the trust fund. But let's assume that the money coming into the trust fund is short by $500. Well, you see, Uncle Sam claims that the trust fund is solvent because in reality, the interest that's being paid covers the deficit. And see, when there's a deficit, Uncle Sam needs to come up with the cash to make up the difference. They cannot put in the IOU of another check. That's the rule. And that started happening around 2010. So they consider it solvent because even though there's no money in the trust fund, even though they're used to paying the interest in another check, now the fact that the interest is owed is more than the deficit than we're paying out, it's solvent. Now, as we go on through the years, it's going to be short by $600, $700, $800. The minute that it gets over being short in contributions over the amount that we're paying in interest, I know this seems a little difficult to understand, right? This is how crazy it gets. So the minute that we're short by more than 1,000 of the interest we're putting in, now they claim there's a problem. That's when they say that Social Security is good until the year whatever, 2025, 2030, or whatever it is. That's when the deficit becomes larger than the interest owed. But the reality is there is no money even in the trust fund. At least pension funds that are owed to public employees and pension funds that are owed to union workers, at least they have an asset base, investments, to be able to make some of those payments, even though they may be underfunded. Well, this is the new meaning of underfunded. Social Security doesn't even have an asset base. They don't even have investments. They don't even have anything in here other than the contributions coming from the young to pay the old. So here's where it really gets to be the income inequality. That if the extreme example, if someone's making at least $120,000 a year, they're contributing $600 a month, by the way. Let's just assume that if they enacted a program today and you were making $120,000 a month, and this program said you're going to have to pay another $600 a month to whatever program they enact. Can you imagine? There's no way this would pass. Even if you made $120,000, there's no way you're going to pay an extra $600 a month into this program. Now, some of you may say this is a little bit of what Obamacare was, and that's partially true. For a lot of Americans, their premiums have gone up. Maybe not as much as $600 a month, but between premiums going up and deductibles rising, it's almost similar. And why is that? Well, that's because Obamacare is another socialistic program. It's another Ponzi scheme. So instead of the young paying for the retirement of the old, it's now the young and healthy paying for the health care costs of the older and unhealthy. It's the same thing. At some point, the young are not going to be able to make the payments in Social Security taxes and Obamacare taxes to pay for the old. At some point, we're not going to be able to kick the can down the road anymore. So now, all of these contributions over a 40-year time frame, if you made $120,000 a year, how much would that be? Well, anywhere between $3 to $6 million per person, depending on if you can get it between a 7 to 10% return. That's per person. Two people making that would be $6 to $12 million within a household. And that wouldn't just be your household. That wouldn't include the households within your outer family, in your family circle. Your brother, your sister, if they're married. Do you see what's happening here? We are giving up in Social Security contributions to Uncle Sam to make all of these choices for us, to which if we were able to keep these contributions and have them invest over 40 years, we would be able to make these decisions ourselves as to what we want to do with retirement savings and income and healthcare costs and college costs and all these things that supposedly government is giving to us. But government is taking millions of dollars away from households to be able to make those choices for us. I say, let the households keep the money, let them make their own decisions. I mean, it's very simple to see just how destructive this is. Even a minimum wage worker over 40 years, if they would make in Social Security contributions, if they got a 10% return, they'd almost have $900,000. You see, so anywhere between that and the 120, wherever you end up, you can see the millions of dollars that could be saved and made. That whether you spend it or not, can you imagine how much of a legacy you could create to the next generation of 40 years if you would purchase life insurance with that extra money that you didn't have to spend? Right? Now we're talking even more millions for the next generation. Now, because Social Security is such a poor investment, we have the investment community out there saying you need to invest 10% of your pay in stuffing these 401k plans, to which we've had the Federal Reserve create booms and busts over the last 15 years that have made your 401k plans become 201k plans. Now, recently, because of the Federal Reserve lowering interest rates to zero and printing money during the Obama administration, we've had an increase in the stock market. But what's happening since Janet Yellen has raised rates? The stock market has basically crashed by 7%. Here we go again. Are we going to see the same thing again? Your 401k turn into a 201k. And what happens when a college graduate graduates and starts his first job and he's told that you're supposed to put 10% of your pay in that 401k plan? He already has student loan debt. Now he puts 10% in his 401k. Now he doesn't have a lot left over. Well, now what? Now he has to go on a credit card. See, that doesn't make any sense, especially if the credit card is 10 to 20% interest. Now, instead of him going up the economic mountain, he's going around the merry-go-round. He's not climbing. Now he's looking for Uncle Sam to give him a break on his student loans or to add to his 401k or whatever, right? We need Americans to take responsibility for their own finances, for their own investments, and let's get Uncle Sam out of the way so you can climb that economic mountain yourself for the freedom that everybody wants to have to make their own decisions the way they want to make them for their own family. So, hopefully this gives you an idea as to how much those Social Security contributions are, and that the reason for the problem and the income inequality is the lack of compounding by not being able to invest those contributions. Now, maybe a good happy medium would be the amount of money that you contribute, you get to invest. The amount of money the company contributes on your behalf goes to Social Security. But as you can see, the problem with that is we're already paying out more in benefits than we're taking in contributions. If we send half to Uncle Sam, that means they're gonna have half as much, right? Now the deficit even grows even more. You see where the catch-22 is when it comes to the Federal Reserve printing money, the Treasury spending money, and the ability of the Treasury to tax the American public. Well, that's all for now. I hope you appreciate the presentation. Take a listen to our 2 Minutes in the Danger Zone, as well as the article on the Social Security slot machine. Until next time, see ya.